today. Well, with that, let's move on and put the spotlight on the FMCG space. Quite a few developments happening there. We have Abneesh Roy, Executive Director at Nuvama, joining in. Abneesh, morning. So I want to actually start off with the note that you guys put out on Trent. I saw that because Trent, I think, spoke to the entire analyst fraternity, explaining their roadmap from here on. And I think the headline is that 25% growth on a sustainable basis is something they think is doable and they think is healthy. What's your sense? Because the stock has actually recovered quite well after falling from its hallowed highs. It fell down and it's recovered almost $1,000 in the last 4-5 weeks.
Yeah, thanks. Good morning. We remain quite positive on Trent. So yes, the analyst meet was useful, and then the annual report this time is quite detailed, gives a lot of insights. So you're absolutely right. This is a compounding machine. We see 25% plus compounding continue. And company has highlighted 3 more verticals where I think longer term growth can really improve. Innerwear, and definitely in terms of footwear, and even in terms of beauty. These are initial days. In fact, in footwear, already they are one of the larger players in the listed space. Company is investing a lot in terms of automation and the customer experience, a lot of RFID. This will really improve the inventory management, tracking, etc. So the street had a concern on the same-store sales growth. Of course, the base was high. On that base, there was some slower SSG. But company highlighted that they are looking at more density of the Zudio stores and more market share. See, whenever they'll open more stores in a micro geography within the same city, same store sales growth will become lower optically. That is a wrong way of evaluating a company like Zudio or a Trent, because ultimately company is aiming for a higher market share and better experience and larger stores also. So we remain quite positive, and the healthy correction which had happened, a lot of that, as you rightly highlighted, has been recouped. But we see 25% compounding continue for this company, medium long term. So we are quite positive. Right. 6627 is our target price.
6627, got that, Abneesh. And good to have you on the show, Abneesh. Let's talk about the other name, Avenue Supermarts. They've entered a new geography, UP. And, the street liked that, actually. What's your view on the stock?
Absolutely. Here also, if you see for Avenue Supermart, Agra opening and Uttar Pradesh kind of such a large market. Uttar Pradesh population, if you see, is larger than many countries. So I would say that this has to be taken seriously, and medium long term, Uttar Pradesh can be a very large market for Avenue Supermart. They already had some presence in the NCR zone, but Agra store opening clearly lays out the ambition for that state. And if you see out of the 28 states, just 4-5 states, D-Mart has a good presence. So we see the other states also catch up. Near-term concern remains that in quick commerce, new players are entering. So that concern continues to remain. So margin pressure in the near term will be there for D-Mart. But from, again, a compounding new store expansion, that will definitely sustain. So we are positive on D-Mart from a longer time frame. Currently, our top picks in this space will be Trent, V-Mart, and Titan.
Okay. Trent, V-Mart, Titan. On Avenue, though, just a quick one. We were discussing this with Mangalam yesterday. How much is these categories like apparel and low-value fashion, etc., as a percentage of sales? Because presumably those are doing much better than traditional core FMCG products, right?
Yeah, apparel and general merchandise is almost 1/4 of the business, and that is a higher margin business also. And there, if you see the kind of price war which is happening with the quick commerce will also be lower. So yes, FMCG, we see that it's more competitive for the retailers. And definitely, if D-Mart can keep improving the assortment and the price value equation, sharper pricing, which say Trent Zudio has demonstrated, say in apparel, that would be the right, I think, strategy for D-Mart to diversify and get more out of apparel and general merchandise. So that's a higher margin business also.
Okay. You have coverage on Vishal Megamart, Abneesh?
No, we don't cover, but yes, in terms of growth metrics, in terms of sharper pricing, that is a very strong number the company has been delivering. And in the medium term, I would expect, given they have done well, that can continue. The concern on that P stakes. See, P-owned companies will have that, right? We should not club typical promoters of, say, Avenue Supermart and compare that with a P-promoted company. That P promoters have a definite timeline, and they will keep doing that. So that's not the right metric, say, that the promoter is selling. I don't think that is a big concern. But yeah, from a growth matrix, I think the company, Vishal, is doing quite well. And I would expect that to continue medium long term. We don't have a coverage on this.
All right. Abneesh, what about Sun TV? There is value, there has been value. But now you have another problem. That's the promoter feud. What's your view on the stock?
Yeah, the valuation comfort in Sun TV has been high. But if you see 3-4 key things, post the Disney and overall Star Viacom merger, definitely the number one player is now much larger than other players. Second is, whenever promoter feud happens in any company, the stock generally has more concern, and definitely the management bandwidth also could get allocated for the feud. So that's a negative. So yeah, Sun TV needs to have a more professionalized approach, more aggressive approach in terms of OTT also. So near term, we'll prefer more Zee, PVR and Saregama over Sun TV. Sun TV valuation comfort is there, but this new development of the promoter feud, I think that's slightly overhang on the stock till we get clarity.
Right. And this entire Zee thing now, how do you view it, Abneesh?
Yeah, I think any company where promoter has more skin in the game, on paper it is good. What I think investors would now like to see is how is the allocation of the huge cash on the balance sheet. Almost 2,500 crore cash is there on the balance sheet. And once promoter puts in money, it will become almost 4,700 crore cash. That's a huge portion of the market cap. So how that is used in terms of which acquisition, whether it adds value in terms of more digital play, more niche content, that will be one. Second is, of course, in terms of transparency and corporate governance, you would again expect that the last 2 years, the improvement which is there, that has to be there. Third is on the macro, right? The overall TV broadcasting companies are struggling on the advertising revenue across the board. Because of this geopolitical development, crude oil prices has gone up, which puts a risk on FMCG advertising. That was supposed to recover in FY26. For Zee and Sun TV, both common. I think that becomes a risk because of the crude oil spike. So overall, valuation comfort in Zee is there. But now we need to see on allocation and usage of the funds and on the transparency, which has improved. We would expect that to sustain.
Is it just just 30 seconds, Abneesh, is it just a valuation trade, or you think they'll be able to come back in a big way, competition-wise?
The competition has rationalized. In Z5, we expect further significant reduction in losses. And we do see that margins will keep improving because Z5 losses will reduce. Across the OTT industry, focus is now on sustainable growth rather than just reckless content spends. So yeah, it is an improvement in terms of margins. At subscription revenue, we have more clarity. Advertising revenue continues to remain a challenge. Now, with the skin in the game for the promoters, we will have more of the involvement, and the concern reduces. But yeah, numbers also we see improvement over the next 2 years.
All right. Abneesh, thank you very much. Sort of good speaking with you, and appreciate you joining us here on CNBC TV 18 as always.